Welcome to Make Your Money Matter. I'm your host, Brad Barrett. In our show, each and every week, we aim to help you create a better relationship with your money. And today on our show, we're going to talk about the question that many of you have right now, you probably don't even know you have. Whether you're in your 20s or your 40s or even your 60s, right? It's the question of whether or not you're going to pay higher taxes in retirement. But before we get started, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. Friends, some Social Security benefits or recipients aren't subject to federal income tax on their benefits, but others, depending on their what's called provisional income, aren't so lucky and may have to pay federal income tax on up to 85% of the benefits. Now, before I go into anything further on this is a great suggestion here to speak with your CPA and tax preparer on, helping you determine what your provisional income is as it relates to your Social Security taxes that may or may not be taxed. Now, again, it's unique, and keep in mind that before 1983, Social Security benefits were not taxed. Get that, right? Now, unfortunately, Social Security has been in trouble. We talk about all the time because people are living longer, and we've heard these stats before, and a big portion of our population right now is entering into the phase of needing Social Security. Therefore, the rules have changed in the past to keep Social Security alive, and in my opinion, I get this question a lot, they will likely change more. And I think it will be because there's going to be changes that have to be made to, again, keep the solvency of Social Security. And if you think about it, it breaks down to very simple math because taxes in retirement are determined differently than what you use during your accumulation years, as I refer to, or your working years. Because you worked your way up this mountain, right? Imagine that, this imagery, okay? You worked your way up this mountain. Now that you're coming down the mountain in retirement to live, you have to understand there's a new set of tax considerations. So this new bracket uses what is called provisional income, right? Now the formula to determine what your provisional income will be is basically summed up like this, okay? You add together half your Social Security, your ordinary income, your capital gains, and your dividends and non-taxable interest. That's how you get your provisional income. Now your CPA will do this for you, your tax advisor, talk with them about this, and you will take that number to the chart that you can look up or your CPA will go through, right? And you look at this taxation of Social Security benefits. You can Google that and you can see this chart and it'll break it down for you between married, filing jointly, and single. So you want to say, okay, Brad, how do I read this chart? So basically I want to verbalize this here on our show. If your provisional income currently is below $32,000 or less, and you're married and filing jointly, you'll find yourself in that 0% tax bracket. That's my key there, okay? If you find yourself with $32,000 to $44,000, which is this bracket game here, then 50% of your Social Security benefit will be taxed at your income rate. Now, the largest portion that could be taxable is up to 85%. Now, 85% is a lot, but it's not 100%, okay? So don't get scared here, but it's not an 85% tax rate. I want to be clear there. I get that question sometimes, but it's taxing 85% of your Social Security, okay? That will be subject to taxation. Now, keep in mind that the numbers in the table that you look up have not changed since 1985, and this is what we call that quiet tax, right? Which is when the government does not make changes with inflation to benefit you. Now, someone in 1985 did not need as much income as we all know that we need now, all right? So we have found that a lot of people have found themselves in the lower end of this bracket, whereas more people, I think nowadays, 2023 and beyond, find themselves on the higher end. We have many clients who pay 0% in retirement because they allow their income to stay under the standard deduction and keep the provisional income under the 0% limit. Again, that's a strategy you can go through, but again, you address for that, all of that actually starts today. Planning ahead starts to help you plan for tomorrow. Plan today for tomorrow. It's important. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our show so you don't miss a single episode, and always remember to make your money matter.